for tuning in. With me is Mr. Siddharth Vora, who is the fund manager and head of investment strategies at Prabhudas Lilladher. Thank you so much, Siddharth, for taking a time to talk to us. We were talking about the whole concept of quantitative investing, and as far as India is concerned, it's relatively new, right? Where does it stand when you talk about active as well as passive, and how does it actually work?
So, in terms of size, we've seen that in India, 20% or so is managed passively, around 0.5% is managed quantitatively, and almost 80% or 75 to 80% is managed actively. When I stack these numbers up against US, what I've seen is around 35% is managed quantitatively, close to 50% is managed passively, and less than 20% is managed actively. So obviously the trends are different, and India has a huge potential in terms of growing its assets that are managed more systematically using quantitative methods.
Right. And as a fund manager, what do you exactly like, where do you stand, right? Because when we talk about active, of course, it's very actively management, fund managers and even passive. But when you talk about quantitative, it's mostly, related to AI and, like, as you mentioned, man with machine. So how does the man work with the machine in this case, especially when you talk about, portfolio management? Because certain decisions obviously have to be made, in certain ways.
So you asked or you spoke about two, three things. One was you mentioned AI, and the other is the whole concept of man with machine and portfolio management. So AI is something we are staying clear from. What we rather want to do is blend real intelligence using help of machines rather than trust artificial intelligence. So right now everybody is only talking about artificial intelligence.
Right.
We are saying no. With fortunately, with the pedigree of research that we have, surviving in the markets for 80 years as an organization, and with the kinds of teams that we have, we want to blend real intelligence, investing insights, and wisdom gained over the years, but use machines, technology, quantitative techniques to enhance this traditional research and traditional investing frameworks. That is what we're trying to do here.
Right.
And when we talk about portfolio management services, again, my job is to think of the strategy, think of each and every layer of the strategy, build a team of people, competent people who understand the domain of finance, investments, programming, macros, fundamentals, technicals, build a team like this and make sure that I can program and test this whole strategy out. That is the role of a person like me when it comes to managing funds.
Right. And you recently launched the new Aqua, fund that was mostly based on the quantitative investing approach, right? How has the performance been, and what kind of alpha returns are you seeing that? And what kind of trend that you're seeing in this space?
So Touchwood, we've launched it in June, towards the end of June, and as of 30th August, we've generated absolute returns close to 15.3%, and our alpha has been close to 8.5%, or 9%, so to say. And obviously, that's significant alpha. But the good part about the alpha is that in the month of July, in the month of August, and now as we move into September, the alpha has been generated in each of those shorter time frames as well. So the alpha is granular. More than 75% to 80% of our stocks have outperformed the benchmark. Rather than few stocks leading to big gains, granular portfolio is doing very well. And that is why our confidence is very good. And the good thing is, in the month of August, the markets were flat at negative 0.6%. We were up 6.8% for the month of August as well. So we've generated close to 4.5% alpha in the month of July, and 6.5, 7% alpha in the month of August as well. And that is, sticking to the promise, adaptive, quantitative, unbiased alpha. The whole mission of Aqua is to deliver sustainable alpha to investors.
So in this approach, as said that it mostly quantitative investing is mostly like beating the benchmarks, but that obviously cannot be the case all the time.
Cannot be the
Yeah.
case, no.
So what are the kind of challenges that you would face, because still in a very initial stage of trying this approach, right? So as a fund manager and as a like looking to into the entire industry, I'm just talking about the quantitative investing approach, the challenges that you are looking at.
So there could, in everything new and everything old, challenges are a part and parcel of the business. Whether I'm managing funds actively, I would face challenges of getting my sector called right, sector called wrong, stock called wrong, my style selection is wrong, my macro view is wrong. So many things can happen, right? Even in the traditional format of managing money. When we come to the quantitative format of managing money, I think the levels of conviction and clarity and reliability I feel are slightly higher, because you're not only able to go by your intuition or experience or wisdom, you're actually able to test this out through cycles. Which means if I believe a certain type of sector should do well, or a certain parameters in few stocks should make them perform well, I'm able to test this out through and through market cycles. So the power that Quant gives us is basically converting your thoughts into ideas, into hypothesis, into testing that hypothesis, which is then a strategy, rather than just going, based on your gut or intuition and managing money that way.
Right.
It's systematic.
Right. But also because I think historic returns and historic value is something that, is looked at, right? So are there chances of missing out the uncertain events that, like it obviously cannot capture, something like that? Does it happen?
So, if it's AI, ML, or black box based model, what would happen is it would only feed from the past data and try to capture trends. But if an event has not happened in the past, it will not be able to react to it in the future. What we have done instead is take examples and case studies of markets, but try to conceive their impact from a numerical point of view. What that means is I have defined rules for everything. So if there is a war somewhere in the world, or if there is COVID, or if there is any political uncertainty, or if some bank in US goes away, irrespective of what is the event, that impact can be converted into numbers. So when we talk about quant, we are not concerned with what is the source of risk. We are concerned with the fact that there is risk which we can detect. And if we can detect the risk in numbers, we can act on it.
Right. I mean, still, it's in a very initial stages, and as you said, like the AUM size and the whole capture market is also very, minimal. So where, like, do you see it as a very big opportunity as well, being in this space, and also for investors specific, like, how do you think it will help them?
If I didn't see it as a huge opportunity in India, I would not put my entire life behind this, and I would not put my organization's key future mission and vision around quantitative asset management. And as I told you, right, India is managing less than 0.5% of money using quant methods. This number can go to 10, 15, 20, 30, 40. At the same time, the industry is also growing. So this is an industry where we believe there is market size gain and market share gain. Both can be batting for us, and that is why we believe this is a huge opportunity for us.
All right. Thank you so much, Siddharth, for talking to us.
Thank you so much. It is a pleasure.